Welcome everybody. My name is Mike Wade and I'll be your host for the next, about 40 minutes while we sit back and discover why your 401k or other qualified plan will fail you. 40 minutes is just a little bit longer than it takes to watch a Gilligan's Island rerun, so I think you can manage it. I'm about to turn this whole notion of retirement planning upside down because we're about to fix the problem too, and I'm going to show you how to accelerate the growth in your plan. So this is kind of informal. Bear with me. Again, my name is Mike Wade. First of all, I want to make it clear that I'm not licensed to recommend or collect commissions on any financial products, so you can relax. I'm not here to sell you anything. In fact, there'll be no buy here button, nothing. I just want to educate you. However, I was a financial advisor for many years, and I saw the light. Now, after I built 3 multi-million-dollar companies, mostly in the financial industries, it dawned on me that I wasn't doing what I was recommending my clients to do. See, wealthy people save money differently. And I understood that Wall Street was full of propaganda, but then the light was shined, and that was it. I relinquished my licenses. This was over 4 years ago, and I decided to dedicate myself to exercising my right to free speech. When you have licenses, there are things you cannot say. Well, unlicensed people like myself can say pretty much whatever we want. It's like us sitting around a bonfire, and I'm sharing my opinions with you. Now, I've started a couple of clubs. One's called College Wealth Systems and Better Than a College Degree. The purpose of these are to educate young adults on personal finance and wealth building. I have personally trained several young adults to specialize in offering what we're going to talk about today. So to be transparent, if you like what you see, I said there's no buy button, you will be invited to reach out to one of these specialists at the end of the video for a personal presentation. And I assure you, you will like what you see today if you hang in there the whole 40 minutes. Be advised, these specialists are young but highly trained. They understand the principles I'll be talking about today thoroughly. Now remember, I earn no commissions, but compensation comes to me later if you choose to continue with your education process with me, and we'll discuss that toward the end. But nothing again to buy today. I'm not going to waste any more time on my credentials. If you want to learn a little bit more about me, judge for yourself while watching this video. Read the reports you have access to above this video. There's free videos and free reports, and we'll talk more about those as we go along. What we're going to cover: I will show you something that Wall Street and its advocates will never show with you. I'm going to compare your plans with a better plan and let you use common sense and logic to come up with your own conclusion. All I ask is that you watch the entire presentation with an open mind and listen. I don't expect you to retain everything we speak about. Again, at the end of the video, I will provide instructions on how to request a private one-on-one, no-obligation consultation, entirely up to you. Quick disclaimer, I'm not going to read this whole thing. The information discussed in this video are basic and general in nature and intended for educational purposes only. No specific companies or products will be mentioned or illustrated. I am going to refer to the S&P 500 index, which is trademark of McGraw-Hill. And again, I am not licensed. All right. Now, according to the Social Security Administration, over 6% of all Americans will be reliant on government, friends, relatives, or charity for at least half of their income during retirement or be dead before the age of 65. Now, considering that the average Social Security check is about $1,230, and that fluctuates year to year, that would mean that over half the people out there in retirement are going to have to live on about $2,500 a month. Now, I don't know about you, but I would not consider this financial freedom. Now, if you watch any media, television commercials or whatever, or you've heard it on radio, you've heard it all over the place, Wall Street advisors, planners, these guys that are trained by Wall Street, by the way, will come out to you and say, people don't plan to fail, they fail to plan. Now, they say this as over 55 million Americans, probably about 1 in every 3 adults or even more, are contributing to a 401k plan. That doesn't even include 403bs. By the way, if you're in a 403b, everything I'm sharing with you today is the same. I'm just going to be saying 401k plan, all right? Or other qualified retirement plans like IRAs, Roth IRAs, and such. So essentially they're saying that 96 out of 100 Americans did not plan for retirement, or it never crossed their minds, or they died prematurely. See, I have a better take on this. People are failing to be prepared for retirement because they are provided with plans that fail. It's not you failing to plan. You're being provided with plans that fail. And the 401k, 403b are just two of those plans that will fail you. Now, if you read my report, The Great Retirement Hoax, I talk about the 6 Fundamentals of building wealth. Now I'm only going to mention two in this quick video. Excuse me, I have a touch of a cold. You must understand what your largest asset is. Wealthy people understand their largest asset. Your largest asset is not your home, which David Bach and many of these people that write books will tell you, or your 401k or IRA. Your biggest asset is your ability to earn an income. At the end of the day, everything comes down to income. And most Americans fail to protect their biggest asset, your ability to earn an income. Now I'm going to sum up the great American retirement hoax real quick. Wall Street would have you believe that you should sacrifice today by taking on more monthly liabilities. Now monthly liabilities cost you money, and you're contributing every month to a 401k or 403b. To take on more monthly liabilities in order to collect assets, quote unquote, that may or may not produce income in the future. There's no guarantee whether or not that income will be generated, and you have no idea of how much income will be generated after taxes. So basically, you should bet today for some unknown results tomorrow and pay the house during all those years, Wall Street and banks. A whole bunch of money over time. Now folks, that sounds a hell of a lot like Vegas to me. Could it be that Wall Street is the largest casino in the world? Now fundamental 6 of the 6 is you need to understand that cash flow is king. You know, all these doom and gloomers out there telling you to get gold. I mean, everywhere you go, people are trying to pitch their thing. But at the end of the day, everything you accumulate over your life must be converted to cash. That is one of the reasons home equity is a very poor investment. It never produces cash. Or a second home is a poor investment. It doesn't produce cash unless you're able to rent it out part-time. See, it's not what you accumulate. It's what you keep. All you should ever concern yourself with is if what you are doing today will produce an income now, soon, or in the future, and how much income it will produce. That's it. Cash flow is king. Now there are two types of money when you get to retirement. There are needs and there are wants. Needs are pretty obvious. You need shelter, you need food, you need transportation, you need clothing, you need health care. And Social Security is going to provide you with a small portion of that money. And do I think Social Security will be around? Absolutely it's going to be around, but there are going to be different rules. It may get taxed. Obviously, as we age, younger generations, they're going to have to retire at later years. But it will be around. Then there's wants up here. This is red money. This is your golden year retirement where you're going to travel a lot. You're going to play a lot of golf. You're going to visit the grandkids. You're going to spoil the grandkids. That's red money. My job, what I'm trying to show you today, is to fill in this gap on this green money. And then we're going to float over a little bit into some of that red money by building a solid foundation here. Okay, so you have green and red money. Whoops, sorry, I'm all over the place. Now there's some factors that are going to affect your final results. When you're investing, interest rates, inflation, economic conditions, taxes, regulation, legislature, human nature, your discipline, and I hate to say it, but a whole lot of luck too. A lot of rich people did get lucky. They'll never admit it, but yes, they got lucky. And that's okay. You have luck staring at you every single day. You just have to jump on the opportunity. Now basically there are actually 5 places to park money while you're saving for retirement or just putting money aside. One's banks, one's real estate, one's Wall Street, one's insurance, and the 5th one is your own business. Now I'm a big proponent of owning your own business even if you don't make money. There is nothing wrong with network marketing. I don't do network marketing, but it's your own business and the advantages are tremendous even if you don't get wealthy. But you can learn more about that in all my videos. So what we're going to talk about today is Wall Street and insurance. Now, we laid some groundwork. Let's get busy building some massive wealth. So when I'm finished with you, I'd be surprised if you continued down the same route or continued with your 401k plan or other qualified plan. So going forward, let's just use some common sense, logic, and some good old-fashioned real numbers. Real numbers that Wall Street will never show you. Doesn't that sound refreshing? Let's talk about Wall Street. Wall Street propaganda is breaking Americans. So let's be clear. You are not investing if you have money in Wall Street. You are speculating. Investing is when you pretty much know the outcome. Speculation is what you do in Vegas. Betting on the house. Betting on red or black. And unfortunately, that's not even a 50-50 bet because there's green pegs. And green pegs on Wall Street are commissions and fees. So here's some of your Wall Street options. You can invest in stocks, which is ownership or equity in a company. Bonds, which is debt or loans from a company, government institutions, or whomever. Commodities, options and derivatives, mutual funds, hybrids, and whatever the heck the flavor of the day is. But today we're going to focus on your 401k or 403b or whatever. It's a qualified retirement plan. And all a qualified retirement plan is a shell that you can put investments inside that provides you with tax disadvantages. Now you're sold that you're getting tax advantages. Your money can grow tax deferred. You can take tax deductions on your contributions. Folks, these are one of the two is a disadvantage. It's the biggest propaganda ever put on the American public by Wall Street. Now there's 12 problems with your 401k. I'm going to kind of fly through these because we don't have a lot of time. Number one is you're saving pennies to pay dollars. The tax deductions you were receiving today on your contributions. Over 30 years, you'll pay back every single dime of those savings in your first 3 to 5 years of withdrawals. You're saving for the government too. Understand the government does not put anything out there for the American public that they do not benefit from. It's estimated there's $7 trillion in back taxes due to the government in these qualified accounts. That would go a long way toward paying off our national debt. Problem two, it's trapped money. You miss opportunities. And that's the second biggest problem, or the biggest. Opportunities pass you by daily and you cannot act on them. Problem three, how can you win the game if you don't know the rules? You only know today's rules. The government can change the rules of these plans at any time they want. It was just a few years back when the 401ks were crashing that Obama came out and talked about forcing people to invest in government treasuries. Well, what a great solution that would have been. It's not the golden watch, it's the golden trap. Oh, I can't leave this company because I got my 401k plan here. 401ks provide no cash flow, and we know cash flow is king. Inflation, which is a problem with every plan. Internal fees, just wait until you see this. This employer match misunderstanding, it's not as great as you think. No knowledge, you really don't have the time to look at what you're investing in. Do you sit around reading prospectuses and actually allocate your money in your 401k? I know there's some of you engineer types out there that do that. But as you'll see in a moment, that's propaganda too. No ownership, pass the buck. Right now as I record this video, the market is up 18% for the year. Everyone is high on their 401k. Everyone loves their 403b. This is it. Right up until the next crash. I've seen it happen. I've been alive long enough to see it happen over and over again. And then you start pointing the finger when maybe you shouldn't have been in there in the first place. And folks, you can't time the market. I don't care what you think. And of course, there's this huge misunderstanding of human factors, like curveballs that are thrown to you. Something emergency happens in your life and your money's sitting in a 401k plan. You can't get to it. You can get to it, but you're going to pay penalty and taxes, or take out a loan that you have to pay, or it becomes a withdrawal. It's trapped money. But the biggest problem of all is your choice of investments, or should I say your lack of speculative opportunities. You are forced to invest in the market because Wall Street put these out there. And here's what the market looked like for over the last 20 years. Now, could this be the future? I don't know, folks. I don't have a crystal ball. I have very strong opinions, which we'll discuss in a moment. Now, I'm a big antagonist of 401k plans, as you can probably see, because I know there's a much better way. But since most Americans have been brainwashed on this subject, let's make the best for it. Let's just go ahead and make the best of it for now, and let's look at these plans a little deeper. Now, if you insist on being in a 401k, my recommendation to you, my opinion, is that you just move all your money into an index fund, like the Index 500 fund, Russell 5000 fund, and get the heck out of your own way. I say up here, if you must be in the market, satisfy your thirst, just be in a fund. Now, I'm not the only one that says this. Some of you may have heard of Warren Buffett. And he goes on to say most investors, both institutional and individual, will find the best way to own common stocks is through the index fund. Those following on this path are sure to beat the net results delivered by the great majority of investment professionals, meaning mutual fund managers. Warren Buffett. Peter Lynch, he's a legendary fund manager at Fidelity during the 80s and 90s when these things took off. And here's what he had to say. The statistical evidence proving that stock index funds outperform between 80 and 90% of actively managed equity funds is so overwhelming that it takes enormously expensive advertising campaigns to obscure the truth from investors. So three of us are sitting there telling you, and I know I'm pale in the comparison to the other two, that if you're going to stay in your 401k, at least just move your money into an index fund and get out of the way. Quit trying to manage it. Now here is the biggest problem of all. It's the losses that kill you. If you get nothing out of this video at all, ingrain that sentence into your mind. It's the losses that will kill you. Now, Wall Street will come out to you and talk about averages. Well, the S&P 500 averaged 11% over the last 20 years. The S&P 500 did 8% over the last 10 years. Blah, 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 blah. And folks, nothing, and I mean nothing, works on averages. And Wall Street goes great lengths to convince you that everything works on averages, and that you pay much higher in taxes than you really do, to convince you to make bad decisions. Here's the big lie. Now this is a big exaggeration, but I do it to make a point. Let's say you have a friend that comes up to you and tells you about this awesome mutual fund he read about that has averaged 25% over the last 4 years. You get excited thinking you'll be able to double your money in less than 4 years, so you move $10,000 into this mutual fund. And sure enough, the mutual fund does exactly the same thing it did the previous 4 years over the next 4 years. In year 1, it's up 100%. The following year, it's down 50%. In year 3, it's up 100%. And the final year, it's down 50%. If you add those four together, you come up with a 100% return. If you divide that by 4 to come up with the average, you have an average of 25% return. And legally, the mutual fund company can put on their prospectus that their mutual fund averaged 25% per year. Legally. Now let's put real dollars into the game. You had $10,000 in there. It went up to 20, dropped back down to 10. Went up to 20, dropped back down to 10. So while the mutual fund company's out there bragging about their awesome returns, sucking more money into this fund, the reality of it is you have no return at all. You're back to ground zero. But it gets worse, because you're going to pay a fee to have the privilege to be in this fund, and that fee can range, but let's say it's a 2% fee. So at the end of 4 years, when you have to pay a 2% fee on this fund that magically created 25% returns over the last 4 years, you lost $1,000. Factor in inflation, and you lost more. That's how people get suckered into Wall Street. Because there's a difference between average returns and effective returns. Because it's the losses that kill you. If you have a 50% loss, you need a 100% return to break even. Now here's some major losses the Dow Jones Industrial Average has done since 1900. And if you look at this, you'll see that the average loss of 47% every 11 years. Yep, market's spiking right now, but we'll talk about that in a moment. 47%. So you need 100% returns just to get even. Now I'm going to share with you my opinion of why I believe the market will remain flat for decades to come. That doesn't mean it won't grow. That means it's going to remain flat. First of all, the total market index right now is $17 trillion, which is 108.4% of the last reported gross domestic product. Saying that the value of all these companies, and it's not all the companies in the world, I mean, it's not even all the companies in the United States. It's a handful of 3, 4, 5,000 companies, and I don't even know how many companies are on the New York Stock Exchange anymore because I don't pay attention, that they're saying is worth more than our gross domestic product, not including all the other small and pop shops. The U.S. stock market is positioned for an average annualized return of 2.6% in the real world, based on historical valuations, and that includes a 2%. That includes dividend yields of 2%, and few companies pay dividends. All right, that may be confusing to you, but let's look at a simple one. The reason the market's up right now is because the Feds keep coming out and saying they're not going to ease up they're not going to stop their quantitative easing, meaning they're going to keep flushing money out in the economy. So interest rates remain low. And when interest rates remain low, investors put money in the stock market because they can't survive on 1% returns, forcing the market to go up. And understand, the market goes up and down in value based on buying and selling. Aging boomers as you'll see in a moment, you probably don't want your money in the market in a volatile situation when you retire. So people that retire and have these big 401ks, IRAs, or whatever, sell out, put their money into fixed instruments. And when you sell, markets go down. Earnings are actually down for over 60% of companies. Even though they reported earnings are better than expected, they were still down. They were just better than expected. They weren't down as much as they thought they'd be. The market is tremendously overvalued. One of these days, ask me what I think of Facebook. Talk about a very overvalued stock. Don't forget about the worldwide turmoil and catalysts. It seems like every 6 months something coming out. Now we got Syria going down. You never know. These things affect the markets. Unemployment, much higher than you are led to believe, and worthless treasuries. I could go on, but we don't have time. I'm just saying, in my opinion, the market's going to remain flat. Now here's the truth. If you look at this chart, you'll see the stock market going back to 1896, and you'll see a nice, steady growth. Then we had this boom here, right before the Depression. Then you get back to your nice, steady growth. What this steady growth represents is the growth in the gross domestic product. So there you go. Go up, up, up. Then we started getting a little heat going here because the United States economy, that's right after post-World War II, started really booming. But boom! What happened here? All of a sudden, did our GDP jump up 500% over the next 20 years? 18 years? Why all of a sudden this surge in the stock market? Well, I got news for you. 1980 is when the 401k was introduced and the propaganda machine began, turning the stock market from an investment environment to a speculative environment. And now we see what's going on now. Let's change gears and talk about insurance. Now don't freak out and run away, because I'm going to share stuff with you today that you probably just don't know. And you don't know what you don't know. But insurance is the most stigmatized and misunderstood option, and it's the only option that can guarantee income for life. Now, this slide is a little misplaced, but I have to put it here. So if you get a little lost here, that's okay. We'll come back to it. You'll understand it later. But the New Wealth Group's approach is 3 buckets. You have your green money bucket, your yellow money bucket, and your red money bucket. We talked about green money and red money. Green money is your conservative money that has to be there for retirement. Okay? You want to receive returns of 3.5% to 8% in this bucket. Then you have a yellow money bucket where you can put some money and take some moderate risk and get 6 to 16% returns. And yes, ladies and gentlemen, we'll talk about that. You can get 16% returns, or go into an aggressive area where you can get 10 to 30% returns. But the whole idea is to start this green money bucket, borrow from this bucket to invest in yellow, take the returns and put them back into your green bucket. Borrow from your green bucket, invest in the more aggressive stuff if you choose, and take the returns and put it back into your green bucket. This is how you accelerate the growth of your money. This is how wealthy people get wealthy. And I'm going to show you exactly how to do that today. Now let's, again, talk about insurance products. It's a better alternative, and I'm about to prove it to you, so hang in there with me a little longer. Specifically, we're talking about cash value life insurance. But we're talking about a new generation of life insurance called Index Universal Life, or IUL. What this product can do for you during your living years seems next to impossible. There has been a 40% per year surge on the sales of these products because people are getting the word out. The problem is there's just a bunch of mutts out there presenting this that have no idea how this stuff really works. I've seen network marketing companies try to do this. I'm going to show you the power of this today that will blow your mind. So it's very important. Insurance, as defined, and its very nature, is meant to reduce or eliminate risk in your life. And this would include your green money, the money you cannot afford to risk, the money that has to be there in retirement. Now let's just talk about index life insurance and life insurance in general. Basically, you're going to pay premiums. Just like a contribution to a 401k, you're going to make a contribution to your IUL. Out of those premiums, they are going to extract cost of insurance, expenses, and premium load. That's your expenses. Whatever is not pulled out of there, the remainder of the money is put into a side bucket that is called your account. Now, We talked about index funds, 500 S&P 500 index. What's going to happen is in your side bucket, they're going to credit that side bucket with the upside of the market, up to a cap, which is typically around 15%. But the good news is that when the market's down for the year, you just get credited with 0%. And if it's the losses that kill you, we just eliminated your death, because you can never take a loss. Now, expenses can still be withdrawn, and we'll talk about that, but you're only getting the upside of the market. And it has a cap because, well, you have to give something to get something. And it's the losses that kill you. And they do it once per year. There's different options, but I keep things simple. On top of that, if the market's not performing at all, there is a guaranteed rate of return, a positive rate of return, if the market doesn't hit such certain parameters over a certain period of time. Now, all these products are a little different with different bells and whistles. Now, you want to maximize the growth inside your IUL, so what you want to do is minimize your expenses. And what costs you money in life insurance is the death benefit or the survivor benefit. So you want to minimize that survivor benefit. But along with that, you're going to get many options to protect your biggest asset. Number one, you get life insurance. If something happens to you and you die prematurely, your beneficiary gets paid a lump sum of tax-free money, protecting your asset. We'll talk about other protections you get with this stuff. Now, I want to make it clear, because I'm very transparent on everything. Life insurance is the most expensive place to put your money in the early years, and the very least expensive place to have your money in the later years. In fact, one of the biggest stigmas of life insurance is it costs too much. When in reality, I'm going to blow your mind when I show you that it costs maybe 25% of what a 401k will cost you. And you get benefits. Now, you're also going to be able to pull money out of a life insurance when you're ready to cash in at retirement tax-free. My opinion is that this product must be a part of everyone's plan, with very few exceptions. And then we're going to talk about accelerating the growth of your money, and life insurance is the only place you can do this. Now, this is a longer term plan, make no exception. It's a 10, 15, 20, 30-year plan. Don't think you're going to jump in this and hit it big in the first 5 years. But most people watching this video have 5, 10, 15, 20 years. So what can a properly structured and managed index universal life policy offer you? Well, number one, flexibility. Now, throughout this video, I'm going to show you a 401k plan where someone's contributing $500 and getting a $250 employer match, or contributing $500 to a life policy, which is $6,000 a year. Just like your 401k, you have flexibility. Just get the $6,000 a year into that plan. You can do it in one lump sum. You can do 200 one month, 800 the next month. Just get the $6,000 in there as you go along. You need to make your contributions. But then you're going to get protection for all these expenses. Remember, you don't get anything for your expenses in your 401k. In fact, those guys get paid even if they lose your money. But with life insurance, number one, you're going to get death benefit. On top of that, they will pay you a lump sum of money if you come down with a critical illness, a lump sum of money if you have a chronic illness, and a lump sum of money if you have a terminal illness. 1 out of 3 of us will have some sort of disability that will cause us to lose short-term and long-term work. This product will provide you with disability insurance and pay you a set fee every month until you're back on your feet. Or, if it's long-term or permanent disability, the fund will continue to fund itself. In other words, it's a self-fulfilling plan. What happens if you quit working with your 401k? I'll bet dollars and donuts you quit making contributions if you have a disability. With this plan, it continues going along. We talked about safety. There's guarantees. No downside risk. Growth, it will outperform your 403 or 401b in almost every case, and I'm going to show that to you in a moment. Then it's going to provide income to you just like a 401k, because remember, cash flow is king. And it's what you keep that matters, not what you accumulate. And you're going to get that income tax-free, and your money grows tax-deferred. In fact, 33% of all premiums put into life insurance comes from the world's richest 2% people. And it's not for the death benefit. It's because it's a perfect tax haven. And as I mentioned, you're actually going to pay less, get all these benefits for less in costs and fees. Accelerating growth and using your plan today to build more wealth. Life insurance makes the ultimate wealth building system. Notice I didn't say retirement plan. I said wealth building system. Now this might confuse you as well, but let's consider this screen and kind of compare it to your home. So you buy a home, you make your house payment. Out of that house payment, you have interest deducted, property taxes, insurance. You may be paying mortgage insurance premium. You're going to have maintenance on that house, all kinds of expenses to live in that house. But a portion of your payment applies towards principal, and over time your home should appreciate, which creates equity within your home. Now consider a life insurance policy almost exactly like that. You are putting premiums in, or payments, where expenses drop out the bottom, the difference goes into a side bucket, and equity builds up. The difference is, as we all know, homes can depreciate as well. They appreciate and depreciate. Remember, the equity in your life insurance policy can only go up in value. You can never take a loss. Now the key with most Americans, if you're smart, is that you borrow home equity to reinvest. Now unfortunately, a lot of Americans will borrow home equity to buy a jet ski or go on a cruise or just move up a bigger house that they don't need. But the ideal thing is to borrow equity to reinvest. So why don't we do the same thing with a life insurance product? Let's borrow from the insurance company. Notice I didn't say from my life insurance bucket. I'm going to borrow from the insurance company. And they're not going to do a credit check, unlike getting a home equity loan. They're going to fund it within a week, unlike a home equity loan. All they will do is collateralize the value of your account. And they're going to charge you, interest rates vary, but there are caps on the interest rates, but about 5%. Okay? The good news is that that's a loan which is tax-free, and you repay the loan on your terms. When you take out a home equity loan, you are forced to make a monthly payment, come hell or high water. With insurance loan, you pay it on your terms. This is very, very important as you progress with me through the education process. And we're going to take that loan and we're going to reinvest it. And we're going to take that reinvestment and we're going to get more than 5%, and we're going to take all those proceeds and dump them back in our bucket to grow our equity larger, all the time while our bucket is appreciated. Very important. If they're loaning us money out of their general account, let's say you have $100,000 sitting in your bucket of equity. They're loaning money out of their general account, so you are still credited with interest on the $100,000. They just collateralized your account. So you could literally take a $100,000 loan from an insurance company, put it in your front pocket, and earn interest. If the market's up higher than 5% for the year, you earned interest on money sitting in your front pocket. What other plan can you do that with? None. So let's compare an IUL to your 401k using real numbers. Bear with me, this gets fun now. All right, let's go here to right here. Now, we've talked about putting your money into an index fund. So what I have here in front of you is the S&P 500 real returns. I didn't make these numbers up. Going back to June 2002, month-to-month returns. What you see in red is when the market was down over the month, and black is when it was up from the previous month. Now, I think the best way to look forward into the future, since we don't like averages, is to say, well, it'll probably just keep repeating itself. So what I did is I just took the real numbers I knew from 2002 through June of 2013, copied those, and pasted them all the way up through 30 years. I think that gives us a good, reasonable idea of what the market might do. Now, of course, this isn't going to be 100% accurate. You know that. I mean, I don't have to tell you that. But this is going to give you as close a look as possible to what's really going to happen. All right? Now, let's put some money in this plan. Down here, here's what the market does month to month. So I said we're going to contribute $500 and your employer is going to match you $250. I know these numbers are hard to see on this video, so that's why I'm trying to tell you what they are. If we scroll down, in 30 years, we will see that our money grew to $528,646.03. First of all, that's not enough, but second of all, that's not bad. You put a total of $180,000 in here and you have over $500,000. Let's scroll down past this chart and let's look at an index universal life insurance policy. Now what you have here is me putting in $500 because you no longer are using your 401k, you're not going to get an employer match. Or maybe you can go get a raise. So we're going to put $500 a month into this plan and see what happens. Well, if we go down, it grows to $453,439.19. So looking at our chart in the middle, the blue line represents your 401k. Looks pretty reasonable to what the stock market does, right? The red line represents an index universal life policy with nice steady growth. Now from this angle, you'd say this guy's crazy. I sat through this much of this video to see that I'm definitely going to go into my 401k because it's a better deal. Okay, hold on there, Trigger. We got more to go. First of all, you have to take this blue line and move it down anywhere from 20 to 30%. Because every single dime in this 401k plan, when it comes out to you, the whole reason for saving this money is taxable. And I don't know what taxes are going to be in the future. And since I don't know what taxes are going to be in the future, I think I'd rather just not be liable to pay taxes. Because our red line, the insurance policy, not one dime is taxable when it comes out to you. So take this blue line, move it down 20 to 30%. Alright, your 401k is right on the same par. Well, no reason to change except for all the other reasons I mentioned. But I'm not done yet. Before I move on, I want to show you how I calculated the UIL. Remember, you get the upside of the market to a certain cap with no downside. So the red marks over here are year to year, June to June, when the market was down. The black is when it was up. You'll see it was up 28%. So instead of getting credited 28% this year, you're going to get credited with 15%. But instead of you losing 28% this year, you lose 0. Those are the numbers, and you'll see I just repeated myself again, that I used over here. On top of that, I used a typical insurance expenses for a male that's 40 years old, putting $500 a month into the plan, and here's the insurance expenses. So I am showing you all the expenses in a life insurance product over here as well. I'm not trying to be stealth here. I'm trying to be as transparent as possible. That's a pretty good, of course these numbers aren't going to be accurate, but this gives you a pretty good idea where you're going to be. 453 or 528. However, you are going to be charged fees inside your 401k. And those fees will range. Okay? Now you're going to be charged an administrative 401 fee and you're going to be charged mutual fund fees. So let's just say 2%, and I don't care who you are out there. I get 0.5% fees. Whatever. I'm going to use 2% because I can't use every number. So the minute I put a 2% fee in there, let's go back down and see what happened. Remember, you had about $530,000 in this account. And now you have $368,000 because of a 2% fee. Remember, that fee is charged monthly. You just lost almost $200,000 in fees, and people tell me life insurance is expensive? $200,000 in 30 years. And look what happens to our chart now. Just by putting those fees in there, that blue line came a whole heck of a lot closer to our red line. Now let's take this blue line, move it down 20 to 30%, and the IUL is beating it or keeping up with it, even without an employer match. And you have death benefit, critical illness, terminal illness, chronic illness, disability, disability income, and a self-fulfilling plan if you go on disability with your red line. You don't have that with your blue line. But whoa, hold on, Grasshopper. I'm not done yet. That just gives you a real good idea of what's really happening out there. Let's move forward now. Remember, accumulation's irrelevant. What matters is what you keep. So now we get to retirement. And let's take the same numbers and let's go back here. Let's just say, let's give you the benefit of the doubt. Where was I? That you had $450,000 in your 401k. You didn't have these last 2 years of losses. And let's put the same fees, 2%, and $450,000 as what you have in your 401k when it's time to retire. Scroll down here. Now, read my blog. You'll read what I think about how much money you're going to need in retirement. But suffice it to say, I think you're going to need as much income now in retirement as you use now. But let's say some of these planners are right, that you're not going to need as much income in retirement as you have now, because a lot of things changes. Maybe your house paid off, which is a bad idea, by the way. Read my home equity report. You're no longer saving for retirement. You no longer have commuting charges, gasoline and all that to go back to and from work, clothes for work. You're not saving for college tuition. The kids are growing up. All these expenses are no longer there. Now, granted, you're going to have a lot more in healthcare expenses, but let's forget that. But let's say you make $100,000 a year. That's what I'm putting in this box. And you can reduce your needs by 50%, meaning you only need 50 grand a year to survive on. Okay? And let's say you're only in the 20% tax bracket. That means to get your $50,000 of net income, you need to withdraw $62,500 from your plan. And if we do that, you will see that you run out of money. Well, if you do it on a monthly basis, you will run out of money in the 8th year. If you do it on an annual basis, just withdraw it all in lump sum, you're going to get a little bit more longevity out of it. You're going to make it all the way up to, well, about the 8th year. That's it. 30 years of saving, and your money's gone in the 8th year. Now, on top of this, now remember, this money equates to about $4,166 after taxes. You're going to get some Social Security on top of that. About maybe $1,200, maybe more. If you made $100 grand a year, you might get a little more. But let's go down to my little inflation calculator. So you got $4,166.67 coming out. Inflation historically has been about 3.27% over the last 100 years, and that's debatable depending on who you talk about, because government doesn't really accurately report inflation, but let's stick with that. And let's say you want to retire in 10 years. That means that $4,166 you're pulling out is going to feel more like $3,005. That's the spin it would have today. Let's say you have 20 years till retirement. It's going to feel like $2,168.44. And let's say you're a 40-year-old guy that's got 25 years till retirement. Now that $4,166 withdrawal is going to feel like $1,841. You lose. Now I happen to know that this universal index life policy I'm showing you will kick out about $50,000 after taxes a year into perpetuity without ever running out of money. But that's still not enough. It's still not enough. So what do we have to do? We have to think like wealthy people. We have to accelerate the growth of our money. Now everything's about to come together for you. So let's move over to this tab. Okay. Same thing, I got my $500 a month going into this plan, 2% fees, $250 in employer contributions. Below is the insurance product with no extra contributions, only $500 a month. We've already seen how this grows. It grows to this $368. We've seen how the insurance policy grows. It grows to the $452. We've seen the chart. The blue line is the 401k, the red line is the UIL, which we did all the adjustments. You know the benefits now. But now let's do what wealthy people do, and let's accelerate the growth of our money. You'll remember back to the slide I showed you where we are going to borrow from our plan and reinvest it. We're going to take the money that we borrow and reinvest and put it all back into our plan, and we're going to continue this process. So, in this example, I'm going to borrow from my plan every 5 years, up to the maximum amount I can borrow, which is about 90% of that number you see there. No credit check, no hassles, just borrow it. Then we're going to turn around, and you're going to be a member of my club, so I'm going to show you places you can invest it to get 12% returns. Folks, you can get 12% returns. You can get 50% returns. You can get 30% returns. The problem is you're not going to get them all the time. They're not consistent, and you can get those returns safely. In fact, I was getting 6,000% annualized returns on my money, which you'll read about in the Home Equity Trap. Anybody can do it. I explain why I quit doing it. Okay? Yes, you can get these good returns with good due diligence, but they're not always available. So don't worry about the 12%. I'll get you that I could show you where you get that all day long. So now let's go ahead and borrow from this plan. So far I haven't borrowed from the plan. Let's turn on the velocitizer. I'm going to click yes. Now watch this 452 number. Your 452 just jumped up to 751. Just by borrowing from this plan, reinvesting at 12%, and paying back all the proceeds into your plan, you just increased your plan by $300,000. Now, I used to do live seminars, and the biggest argument I'd get with people is, well, if I can get 12% returns, Mr. Wade, why wouldn't you just show me where to do that, and I'll do it with my IRA or something like that? And I said, well, that's fine. You're not seeing the bigger picture here. But here's what happens. If you were able to do $500 a month and invest it and get 12% returns, your money would grow to $1.6 million. Heck of a lot better than my $751,000 in a life insurance policy. But I just told you, to get 12% returns on your money, you are going to have idle time on your money. Meaning there are going to be times you can't find those kind of returns, so you're going to keep your money on the sidelines doing hardly nothing, maybe get money market returns of 1%. Because you can't lock it up. Otherwise, all these opportunities walk right by you. So let's say you have idle time of 30%. Now, you're down to 793. The insurance policy is $751. This one has about $30,000 more in it. The problem is that every dime of this is taxable. And you didn't get life insurance, terminal, chronic, critical illness protection, disability insurance. You didn't get all those other benefits at the same time. Now, if you're asking yourself, well, I can't do this, I'm uninsurable. It doesn't matter. You insure somebody that is, because this is for wealth. What if I can get you 30% returns? Then this plan can grow to $2.9 million. Now, that's a little far-fetched. Yes, I can show you where you get 30% returns on your money. It'll happen occasionally. So a nice blended return in here, it's not too far-fetched to say you can get a blended return of 20%, which will take your $500 a month contribution, $180,000, and grow it to $1.3 million that comes out tax-free. Your 401k will never do that, can never do that. And it doesn't matter. Even if you don't want to accelerate or do this other type of thing, borrow from your plan to reinvest, this plan beats your 401k or 403b. Because it blows it away if you have no contributions. If I take away the matching contributions for those of you that don't even get a matching contribution, let's just put 0 in here. Now what happens? The insurance, well, let's turn off the velocitizer. Show you apples to apples. The IUL beats it hands down, because you still got to move this line 20 to 30% down due to taxes. So that's not even a question. So if your argument is your employer match, yeah, if you're getting 100% employer match, we might want to look at other places to fund this policy. And where can you fund this policy from? A lot of places. Home equity is a great place to start. Now, there's something else I want to point out while I'm on this page. We don't have to just borrow from this plan to reinvest. What if you have college tuition to pay for? Can you borrow from your plan to pay for college tuition? Absolutely. Do you have to pay yourself back? No. Do I recommend it? Yes. Can you borrow? What if a great business opportunity comes your way? Can you borrow from your plan to buy a franchise? Yes. Do you have to make payments on the plan? No. Should you? Yeah, when your business is making money, start putting the money back in your plan. What about real estate? Can you borrow money with an IRA to buy real estate? There's no argument out there, folks. You cannot take out a personal loan and use your IRA as a down payment. It can't be done. Anyone that's telling you that is wrong. But with this plan, you can. But what if you, to get these 12% returns, let's just go to 15%, turn on our velocitizer again, grow our plan to almost $1 million. To get 15% returns, folks, you typically need bigger chunks of money. You're not going to get, it's hard to get 15% returns like down here on $500. That ain't going to happen. So what if you're sitting here in the 5th year of your plan, you only got 18,000, you can only borrow 15 grand from it? Ah, well, that's where the club comes in, folks, because you're more powerful as a group than you are individually. So if you have a $100,000 opportunity and each of you have $15,000, maybe 7 of you come together. You form an investment club or real estate investment trust. You're stronger as a group. And then everybody wins. And you spread the risk. I just showed you, folks, how wealthy people get wealthy. They accelerate their money. And life insurance and this particular product is the perfect tool. You can tell I'm pretty passionate about that. All right. Now, the following is for illustration purposes only, and the exact results will be different. We know that. Nothing works on averages and all that. This is a random policy I looked at. I do not endorse one company or policy over another. As I said, I cannot sell life insurance. I do not sell life insurance. That's the job of the trained licensed specialist. But if you look at an example side by side on your left here, you'll see a typical plan. It's an IRA or 403B and an IUL on the right. Let's say you're 40 years old. You're going to retire at 67. Your pre-retirement income tax is 15%, which is closer to the truth, even if you're making 150 grand. Okay? Let's say your annual contribution is $500 a month or $6,000. You're going to get an average 8.3% return, and you know how I feel about averages, 8.3%, and you're going to pay 2% in fees. On the right, everything's the same. This says 0 annual rate of return. It should say 8.3, apples to apples, but you're only going to contribute $5,100. Over time, this plan on the left, the 403B and 401k, will grow to $425,679, and your IUL grows to $417,797. Well, you'd think this is better, but we know this is tax-free on the right. The one on the left is taxable. So when it's time to take money out, this plan, the IUL, will kick out about $47,800 for after-tax income. To match that same income, if you're now in the 25% tax bracket because tax rates went up, you'll have to pull out $63,733 to have that exact same net, which means by the age of 78, your 401k or 403b is out of money. While the Index Universal Life, the account value grew to over $1 million. How is that possible? The specialist can explain it to you. It's very unique. Once again, we talked about the fees, and I showed you the fees. This typical plan on the left compared to IUL. The typical plan on the left, you're going to pay $92,221 in fees. Even if they lose your money, they get paid. And on the right, you paid about $28,000 for all those benefits. The chronic, terminal, illness, death benefit, blah, blah, blah. You get the idea. Apples to apples, oranges to oranges. The only con to an IUL, it's the only caveat to watch out for. Your fees in a 401k or 403b are variable. Meaning if you're charged 2%, you're just charged 2% of whatever your account balance is, meaning your account can never implode on itself. Fees with an insurance policy are fixed. That's why you have to be disciplined. You have to pay the fees every year, regardless of what's happening. So no matter what you do, if you want to keep this policy alive, you got to cover your fees. Now it gets to the point where the returns on your money covers the fees, and the fees go down over time. So that's why I say it's a longer term commitment. You need to commit to this thing 5, 10, 15, 20 years. It's a commitment. There's flexibility. But don't worry, your specialist can explain all that to you as well. That is the only negative to this plan. The only negative. To The day you start Educational Club, folks, you're probably wondering what's in this for me if I don't make money on life insurance. The bottom line is this: I'm here to pull a group of people together where I can be their coach and trainer, because I have a whole lot more to talk about. This is the foundation. Okay? Where we can pull together. You guys can form these clubs to get in these higher investment. I'm going to bring investment opportunities to you. I want to make it clear that I do not make a commission on any investment opportunity I bring to you. But there is a fee to belong to this club. If you happen to have an insurance policy, the specialist pays your annual fee. If you think you're going to go out, you want to just get in these investments that get 12%, even though I proved you because of idle money time that it's better to have a life insurance policy. That's fine, even though I don't like the idea that you don't listen to me right out of the gate. That's fine, but you'll have an annual fee to pay if you want to belong to this club. I'm not here to sell this club today. That comes later. Right here, I'm trying to give you a concept and try to build a little credibility with you. So it's my strong opinion that you would be a damn fool to at least not invite a trained specialist out to show you an apples-to-apples comparison. I truly believe an IUL should be a part of your overall plan, if not an integral part and the foundation of your planning. So if you're ready to take action, complete the form below. It will be shot over to me, and I will assign it to the specialist in your area. Or maybe you're just happy remaining in the herd, being taken to slaughter. This is your opportunity. There's no obligation. At least get an apples to apples. Get your questions answered. You also receive emails from me. At the bottom of my emails, I put my phone number and my email address on there. Don't be shy. Pick up the phone. Call me. Ask your questions. Understand I'm not a licensed agent. I cannot talk about particular products. I can tell you my opinions. But feel free to reach out to me at any time. Right now, I want you to go ahead and fill out that form. And while you're waiting for a specialist to contact you, in the meantime, take the time to read my reports and watch my educational videos. There's links right above this video that'll take you to those. If nothing else, make sure to read the Home Equity Trap, both Part 1 and Part 2. Like I said, I'll show you how I made 6,000% returns on my money. I'll show you how to make 100% returns on your money. That's pretty enlightening. Then I'd recommend you watch the video on taxes, how you're being lied to about taxes. It's all political. It's pretty eye-opening. Like I said, the link to the vaults are above and yours free. I want to thank you for your time. Fill out that form right now. You have nothing to lose. I hope you got something out of this. And here's to your wealth. Bye-bye.